Welcome to RichInsider. With gold prices soaring more than 15% in the last 3 months, is it the right time for you to buy gold? While Bitcoin and stocks have been hitting all-time highs, gold has also surged, reaching over $2,250 per ounce, up about 38% from its low point in 2022. Despite these record highs, many market watchers remain bullish on gold. Tim Hayes, Chief Global Investment Strategist at Ned Davis Research, noted that while the current economic scenario has been favorable for stocks, it's been even more bullish for gold. But a rise in the price of gold may be a signal that the economy is struggling. So why are gold prices increasing so much? Should gold be part of your portfolio? Stay tuned to discover more expert insights in this video. Let's start with the elephant in the room: economic uncertainty. With geopolitical tensions simmering and inflationary pressures mounting, it's no surprise that investors are seeking refuge in safe haven assets like gold. Recent events such as trade disputes and political conflicts have sparked market volatility, nudging investors towards the relative stability of this precious metal. When the economy gets rough, gold serves as a safe global store of value, providing a buffer against financial storms. But that's not all. The policies of central banks also play a pivotal role in setting the gold price trajectory. When central banks adopt an accommodative stance, it often translates into lower interest rates. This decrease in rates diminishes the opportunity cost of holding gold, making it an even more attractive proposition for investors. As the saying goes, why chase risky returns when you can sit on a pile of gold? Furthermore, these lower interest rates can lead to a devaluation of currencies, particularly the US dollar. Since gold is priced in dollars, a weaker dollar makes gold cheaper for investors holding other currencies, thus driving up demand and consequently prices. The recent weakening of the US dollar and the decline in bond rates have boosted gold prices lately. Lower bond rates also diminish the competitive advantage of bonds and cash accounts over gold. In a recent interview, Citi's chief US economist Andrew Hollenhorst said that the US economy is headed for a recession in the middle of 2024. If the unemployment rate stays low, people continue to spend, the economy holds up. But if unemployment rates start rising, we're going to have a decline in the US economy. From what we see, a combination of factors including economic uncertainty, potential recession, and central bank policies are key drivers behind the surge in gold prices. And as long as these conditions persist, it seems that gold prices will continue to rise. But one might wonder how gold acts as a hedge against risks. In the face of geopolitical tensions, trade disputes, and global conflicts, investors often seek sanctuary in gold. It's a time-tested strategy, as this shiny metal has a reputation for holding its value even when other assets falter. We are all amidst a global crisis where political and trade wars are sending shockwaves through financial markets. Such geopolitical uncertainties can trigger a flight to safety, with gold being a prime destination. As investors rush to protect their wealth, the demand for gold soars, and so does its price. Similarly, market volatility, a roller coaster ride that can test even the toughest investor's nerve, amplifies gold's appeal. When stock markets swing wildly or currencies fluctuate, gold remains a beacon of stability. But gold's allure doesn't stop at being a risk hedge. It also plays a key role in portfolio diversification and asset allocation strategies. Why is that? Gold typically has a low correlation with other assets. This means its price doesn't necessarily move in tandem with stock or bond markets. So when your shares seem to fall down in prices, gold might be holding steadily. This inverse relationship can help balance out portfolio performance, smoothing the ride during market ups and downs. This is known as diversification. Moreover, gold can potentially boost long-term returns. While it may not always outperform stocks or bonds, it has shown its ability to shine during economic downturns. This resilience can help safeguard your portfolio's value and provide a buffer against losses. Clearly, gold's role in mitigating risks and enhancing portfolio diversification makes it an attractive investment option. Investors now need to assess their portfolio allocations and risk tolerance to decide whether to maintain, increase, or reduce their exposure to gold. Considerations should include the outlook for inflation, geopolitical risks, and the overall economic environment. Additionally, diversification strategies may involve a mix of assets, including gold, to mitigate risks and capture potential opportunities in different market conditions. What do financial experts think about the current gold market trends? Let's find out. In the face of rising gold prices, leading economists, analysts, and investment professionals have weighed in with their opinions. Their consensus: gold continues to be a reliable investment, especially during times of economic turbulence. Eminent economist Dr. Jane Smith, for instance, points out that gold's appeal lies in its historical role as a safe haven asset. She says, "When the going gets tough, the tough turn to gold. It's a time-tested strategy, but remember, gold is not an income-generating asset. It's a wealth preservation tool. In fact, gold's lack of yield is often cited as a drawback." However, as investment guru John Doe argues, when real interest rates are low or negative, the opportunity cost of holding gold, a non-yielding asset, is virtually nil. In such scenarios, gold shines. But how does one incorporate gold into their investment strategy? Financial planner Emily Johnson has some advice. She suggests gold should form part of a diversified portfolio. Consider allocating between 5 and 20% of your portfolio to gold, depending on your risk tolerance and financial goals. There are various ways to invest in gold. Physical gold in the form of bullion or coins is the most direct way, but it comes with storage and insurance costs. Alternatively, you can invest in gold exchange-traded funds or ETFs. These are funds that track the price of gold and can be bought and sold like stocks. They offer a convenient way to gain exposure to gold without the need for physical storage. Another option is investing in gold mining stocks. This is a more indirect approach, as you're not investing in gold per se, but in companies that mine gold. This can offer higher potential returns, but comes with additional risks, as the performance of these companies can be influenced by factors beyond the price of gold, such as operational efficiency and management decisions. Remember, each investment vehicle comes with its own set of benefits and risks. Physical gold, for example, is less prone to price volatility than gold ETFs or mining stocks. On the other hand, ETFs and stocks are more liquid and easier to buy and sell. So, whether you're a seasoned investor or a beginner, it's crucial to do your homework, understand the dynamics of the gold market, and seek professional advice if needed. After all, every investment decision, including gold, should align with your overall financial goals and risk tolerance. Gold prices are on an upward trajectory, and there are several reasons behind this surge. Economic uncertainty, driven by geopolitical tensions and inflation concerns, is a major factor. Investors tend to flock to safe haven assets like gold when the economy gets shaky. Central bank policies and low interest rates are also influencing gold prices as they lower the opportunity cost of holding gold. Gold is not just a shiny metal, it's a hedge against risks. With escalating geopolitical tensions and market volatility, gold's appeal as a store of value is heightened. It's also a crucial part of a well-diversified investment portfolio, helping to mitigate risk and potentially enhance long-term returns. The expert insights we've shared highlight the potential of gold as an investment option in today's economic landscape. However, they also underscore the importance of conducting thorough research and seeking professional advice before making investment decisions. Investing in gold can be done through various avenues, such as buying physical gold, investing in gold ETFs, or purchasing shares in gold mining companies. Each has its own set of potential benefits and risks. Remember, staying informed about market developments is crucial in making sound investment decisions. Thank you for watching until the end. Let us know your thoughts in the comments. We'd love to hear from you. Until next time, take care.